Hi, I'm Stephen Tuckwood, Director of Investments here at Modern Wealth, and I'm really pleased to be joined by Neil Falconberry, Managing Director of our Reston, Virginia office. So Neil, another great year for public equities represented by the S&P 500. We're looking here at a chart of the performance over the last 12 months and a few blips along the way, but generally lower left to upper right, which is what we like to see on a return chart. Any high-level thoughts on the year?
It was a lot of fun, Tuck. A lot of fun, and it was fairly similar to 23, which makes it a bit unusual. And I think it's particularly unusual given that it was such a surprise. I mean, going into 2024, much of the discussion was Fed interest rates lead to recession, and the market at one point, I think, was up 29% before finishing the year at 24. So a very nice surprise for the year.
Yeah, absolutely. And we'll get to the back-to-back above 20% returns in a little bit just for some historical context. But if we dig under the hood just a little bit more, we're going to flip to slide 2 here where we're looking at monthly returns. So carving up the year by month. And you can see a lot more positive months than negative months, obviously, with a strong year. And November was a real strong month, and we actually had our strongest trading day of the year within November. December is a little more choppy. Neil, what was kind of going on there for December that ended up being down just over 2%?
Tuck, I think this is somewhat election related. The market really took off post-election, and it was very much following the script of Trump's victory in 2016. And to recall that, the market went up November, December of 2016, every month in 2017, and the first two months in 2018. And the market started off on that same playbook. And then I think came to realize that conditions under Trump's second term are very different from his first term, right? That first term started with Fed funds less than 1%. Inflation was significantly below the Fed's 2% target. The federal deficit was pretty small, less than 3% at that time, and stocks were fairly reasonably priced. That market could absorb a lot of stimulus in the form of tax cuts, right? Now try to call that same play today with inflation still above the Fed's target, interest rates at 5% at the time of the election, and the federal deficit now over 7%. That's an economy that can take much less of that same kind of stimulus. And I think December was the realization that things are, in fact, very much different, and it's not going to be a repeat necessarily of Trump's first term.
Yeah, definitely. And a sticky inflation environment as well. So to your point, to overstimulate and potentially reignite inflation in 25, I think is weighing on the market somewhat as well in December.
Tuck, we had, the Fed saw rates, CPI inflation get down to about 2.4 before inching back up to 2.7. And again, Trump wants to do tax cuts, potentially tariffs, immigration reform, deregulation. Most of those things are stimulative to the economy while inflation is already starting to peak its head and the Fed cutting rates again before inflation gets back under control. It seems a reasonable approach, right, for the market to get concerned about that inflation, don't you think?
Yeah, absolutely. Yeah, it's always a difficult thing to shake. Once it gets really embedded into the economy, it can have these habits of re-emerging when we think it's under control quite quickly. So I think that's playing into the fixed income market as well, and the expectation for Fed rate cuts into 2025. If we flip to the next slide here, we can just dig down a little deeper into the S&P 500 and some points of interest here throughout 24. One of the best trading days of the year was November 6th, which was the day immediately after the U.S. presidential election result. And I think, that's what you're speaking of, Neil, with just that immediate reaction where, the market tries to digest the new news, and we have obviously a big day and on the market, 2.53% higher, and then continues higher. And then the market starts to really think about, hey, what does this actually mean? Is it the same as 2016? And so on and so forth. But certainly a great reaction after that. Top performing sectors of the year: communication services, information technology, the Magnificent Seven, which I think everybody's pretty familiar with, are obviously ingrained there in those sectors. So doing a lot of the performance driving. But financials also had a great year as well, up over 30%, well above the average. 58% of the trading days were up, and that's typical for a positive year. On the flip side, not everything was rosy all the time. August 5th was a real kind of gut check moment. The market was down almost 3% in a single day. And that was following some turbulence in the Japanese market and the unwind of the yen carry trade. But that was really the capitulation point of the biggest drawdown of the year, which, was over several weeks, but it was a 8%-ish drawdown from peak to trough. So that's really one of these moments throughout the year, which we get in the equity market, where it's a gut check moment, and it's, doesn't feel good at the time, but staying with the plan, staying invested during these turbulent times can pay off, and certainly did in 2024. Sectors that did poorly: materials, healthcare, and real estate. And real estate's quite sensitive to the interest rate environment, which we're going to touch upon a little bit later. Healthcare, I think maybe some things there mixed in with the new administration coming in as well. Few significant names sold off within the healthcare space, but always an interesting year. We obviously look back at returns, 25%, but throughout the year we have these moments, and it's really important to focus on the longer term and to really to stay invested to enjoy these. Neil, you've probably seen some data on this. We don't have reference to it here, but missing out on some of the best trading days of a particular period, whether it's a year or longer. If you miss those days, it really is hard to keep up with the averages over the long term. Any thoughts there on just that topic quickly?
Yeah, missing the best days in the market is a much more punitive thing than missing the worst days in the market, surprisingly, right? So again, this is why we stay invested. Talk related to this chart, it's kind of an interesting year in the sense that I think there are many more clients that were really happy about returns last year than maybe investment advisors, right? So some of the higher valuations we see in U.S. large cap, you look at small cap or emerging markets, international equities, really significantly underperformed. Large cap international was a mid-single digit return last year, while the S&P is doing 24%. So there were many disappointing sectors in the U.S., but even attempts to just look outside of U.S. large cap has been disappointing. And yet I think those are, in some cases, really good decisions because valuations are much more attractive in those areas. How do you also think about that from a portfolio construction area, about not only staying with your investment plan in good days and not missing those good days, even if you have to live through the bad days, but still staying disciplined and looking for value opportunity outside of just U.S. large cap?
Yeah, great question. And it reminds me of that old adage of, if you're happy with all the parts of your portfolio, then you're not diversified.
Yeah,
Right?
exactly.
So there's always going to be things that are underperforming, and some benchmark. There are always pockets of strength and pockets of weakness that really makes a portfolio. If you don't have that experience, then you're certainly not as diversified as you should be. And the inflection points of when one section of the market, goes from doing incredibly well to another section taking over that leadership, really hard to predict. So it's almost like being out of the market or in the market. Back to the point of missing the best trading days. Getting those inflection points is near impossible to do that on a continuous basis. So really, diversification doesn't always feel great, but over the long term, it really does, pay to do that. So if we want to flip to the next chart here, just, we talked about the back-to-back years of, 24, 25-ish% returns for the S&P 500 being a bit of a historical anomaly here. So, what we're looking at here is the price return on an annual basis, but also in orange, the inter-year declines. So back to that point of, it doesn't always feel good at every moment throughout a calendar year, but, ultimately the public equity markets do a great job of growing wealth over the long term. What are your quick takeaways here, Neil, on this chart?
If you look back, the last time this happened, it is 2019, 18, 19, and 20. We did that with the assistance of quantitative easing, right? Interest rates were near zero at that point, and that helped drive 3 years worth of above average equity returns. We've managed to pull this off while the Fed was raising interest rates, and mortgage rates are still over 7%. I think it really is remarkable. And I think that's what distinguishes it somewhat from the past. That leaves us a little bit without a precedent for what to do with it, right? In the sense that valuations are now at an extreme, and they're an extreme while interest rates are high. That's a fairly rare dynamic that we see in the marketplace.
Yeah, it is. And on valuations, I think this is really interesting. And we've kind of covered the last 12 months, but I think everybody's more focused on what do the next 12 months look like. So on slide 5 here, we can look at current valuations on a forward-looking basis, and you can see there that we are getting quite stretched. So for those that might not be more in tune with this than others, this is the valuation metric. So in other words, this is the multiple of the earnings of the S&P 500 that we're paying today. If you were to invest $1 in the S&P 500 today, we're paying over 21 times the future expected earnings per share for the S&P 500. So it gives us a sense of the value of the current price of the index. And this then looks back historically here. This goes back all the way to 1994. So you can see just on a historical basis that we are quite high. We've seen this last in 2020, and then even higher back in the early 2000s. So value is obviously incredibly important when we're thinking about investing. It's ultimately not are we buying good things, but are we buying things well? And valuation plays into that. So there are some concerns about this, Neil, as people just look at this and say, oh, well, valuations of the domestic equity market feel rich and stretched here. What does that mean for us on a forward-looking basis typically? And, is there a way here that things do play out without the need for a significant correction?
Yeah. Tuck, I think if you look back on even on a price to sales basis, so what's the value of the market? What are we paying per dollar of revenue, which is maybe less subject to accounting gimmickry, if you will, or just the most honest assessment maybe of value. We are trading at an all-time high, life of country high valuation. This chart on price to earnings shows that we're very near there. I think the best corollary would be the dot-com era, right, where we peaked right just a little bit higher than these valuations. And I think oftentimes the story here is that high valuations imply some immediate correction, but that's not historically how high valuations are worked out. It's much more death by 1,000 cuts, right? The dot-com era had a fantastic sell-off, but it was then followed by a rally, another sell-off, and another rally. And before you knew it, 14 years went by before you set a new high. Meanwhile, earnings are growing, 3, 4, 5, 10% progressively over that time period. And so the valuation starts to come down. So I think what this really means, I think most importantly, is what are your returns that you're modeling in your financial plan? Certainly don't look back at the last few years and start assuming that 20% returns for equities are sustainable, certainly from these valuation levels. Have a discussion with your advisor about what that means, and should you reduce your equity exposure or diversify your equity exposure into some of the other sectors of the market that are less overvalued, and maybe drown out some of the cries here for an immediate correction simply because the market is overvalued, right? These things typically take time to work out. And again, it's usually a process of the market going sideways for a protracted period of time while earnings progressively catch up to the market.
Yeah, definitely. And on the next slide here, we can then talk about 10-year forward returns on a historical basis. So, kind of a lot going on here, but really insightful in terms of, hey, just on a historical basis, when we invest a new dollar at these levels of valuation, then, what type of returns have we experienced in the past? But Neil, I know you really like this chart as well. So maybe you want to add a bit more color there.
Yeah, well, color, I think, is the right word for this chart, right? So,
Yeah.
the scale on the right-hand side is just meant to provide a color code so you can identify periods by decade, if you will. And so if we look just to the right of where the flag is marked for today, the only time the market's traded above 25 times earnings, right? So that's the x-axis on this chart. That's during this greenish yellowish period. That's the dot-com peak, right? That's the only time we've traded at these valuations for a continued period. And if you follow that line across to the y-axis, again, your 10-year future rates of return starting at a PE of 25 to 30 was actually negative, right? So if you bought equities in 1998, you didn't make money for in excess of 10 years. So the chart shows a pretty clear correlation between future returns and valuation, right? Obviously, returns are higher if we can buy equities at cheaper valuations. But from today's starting point, there are still data points with attractive returns, right? Just directly above the today flag on this chart, where there are still periods of good returns. It just gets more and more difficult, right? Things have to line up just right. You can't have a resurgence of inflation, right? You can't have a surprise recession happen, right? You need to slowly and patiently work yourself through an economy and valuation to avoid negative returns from these PEs. So again, it's clearly a concern. We'd much rather be buying equities at 10 times earnings, but directly it's not a flag to start selling equities, much more a message about planning for your future returns in your financial plan and making sure you're accounting for these valuations.
Yeah, and there is always the ability of the underlying companies within the index to essentially earn their way into the valuation. Like you say, it doesn't always mean that there's a large correction imminent and head for the hills type of thing. But it is priced to perfection in some ways, in that we need the economy to continue to be strong. Which
you make a great point there. We've assuming that we're not having a recession. We've just finished this Fed rate hike cycle. The last 3 or 4 have ended in recessions. The last soft landing was in the mid-90s, 93 through 95. And the equity market also was very richly valued coming out of that soft landing. And the market went sideways for a couple of years, but we had earnings growth of about 20% per year for each of those 2 years. And so we enter 1996 not having had a recession or a significant equity sell-off. They just went sideways for 2 years. But stocks were now very reasonably priced following those 2 years of excellent earnings growth. That would be our best case scenario from here, that the Fed has in fact engineered a soft landing. Earnings growth is going to be fine. Maybe the market's pace of growth moderates, but that we still have strong earnings growth right now we're looking at 15% earnings growth projected for next year. If the market still goes up 8, and 15% earnings growth, valuations are coming down while we still make that 8% return. So I think you make a great point there, and that's likely our best case scenario here.
Yeah, one of the inputs to that, to the economy staying strong and earnings to continue to be robust, and risk appetite to remain high across the investor base, all those things have an input that is the interest rate environment. So maybe we turn now to the performance of bonds over 2024, and then we'll end with a look ahead into 25 to see what we might expect from the bond market in general. But here's the Bloomberg US Aggregate Bond Index, just one of the broad measures of the fixed income market here in the United States. And again, this is the annual returns of that index over time, with the red dots being the intra-year drawdowns. So, the bond indices do have pullbacks, just like the equity market does. But, if you kind of reference back to the chart on the equity side, you can see here that returns are much more kind of condensed because we're dealing with an asset class that is less risky than individual equities. So 2024, just above 1% is where the bond market ended up on the year. And 2022 is that real outlier there that you see down 13%, which was, during the time when the Fed was raising rates rapidly throughout 2022. So, 1%, just above 1%, not a great year for fixed income, frankly, but, not catastrophic in any way. It held up reasonably well, but we were faced again with kind of raising rates on the longer end of the curve. So if we flip to the next one, we'll just look at the 10-year over the last 12 months, which is really what a lot of these bond indices are keyed off of. This is the rate of the 10-year throughout the year. So you can see we got down relatively low at the beginning of September, but then we had the rate cut. There was a 50 basis point rate cut at that Fed meeting, the first that began their rate cutting cycle. And the 10-year moved higher. So we had a base rate moving lower, but a longer rate moving higher. And that's really exhibited on the next slide pretty well here. You can see a definite inflection point there. The federal funds rate is the red line. You see that initial step down of 50 basis points by the Fed, and then a couple more quarter point moves in later Fed meetings. But then the 10-year rate moving up 100 basis points from that point. Neil, bonds and the interest rate environment, again, seem like a very key component of the equity market potentially doing well or not in 2025. What are your thoughts there looking forward?
Tuck, I think this is one of the most critical dynamics and relationships we have to understanding future returns here. So, summary, the Fed has now cut rates by 100 basis points, but longer term interest rates, the 10-year Treasury, are now up 112 basis points from where they were the day the Fed cut, right? So I think people are very surprised. Certainly home buyers are surprised to hear now we've had 3 Fed rate cuts and mortgage rates are actually still going up, right? So if we think about that if we break this really into 2 periods, we have the first Fed rate cut until the election, right? So at the time of the election, the Fed had cut rates by 50 basis points, but long-term interest rates had already gone up by about 65 basis points, right? So I think there's a message there potentially that either the Fed is making a mistake and they're cutting interest rates too early before inflation gets back to their 2% target. They started cutting when inflation was still around 2.5. We're now back up to 2.7. At a very hot jobs number this morning. So I think that's a very real possibility. I think the other possibility is that the long part of the bond market had already started to price in the negative ramifications of a Fed rate hike cycle, and that a recession probability wasn't low. It wasn't 100%, but rates were probably too low, and that now the Fed trying to step in front of the implications of having raised rates may now have saved us from a recession. We'll have a soft landing, and rates need to normalize. That's maybe the more optimistic interpretation, I think, of the bond market. I think the more pessimistic one, obviously, is the Fed is making a mistake here in cutting too early, right? So again, bond market, Fed cuts 50, bond market goes up roughly 65 basis points. Then we have an election. Since then, the Fed has cut another 50 basis points, and the bond market's still up another 60 basis points from there. So I think now we're adding to the murkiness of 2025 this possibility that maybe the Fed is cutting rates too early before inflation's out of our system. And now we have an administration that wants to cut tax rates. That's pro-growth. That's pro-inflationary. They want to engage in deregulation. That potentially is pro-growth, pro-inflationary. I think China's economic growth is so weak now, they're getting ready to launch another very large stimulus program. I think the bond market is giving us a message here that there is inflation building in the pipeline, whether that's from the monetary side or it's coming from the fiscal side. And I think support for that view that inflation pressures are building comes from the gold market. We don't really think about gold as being a major asset class, but 2024 was the first time gold and the S&P both went up more than 15%. Right? Normally, when equities are doing that well, it's not an environment where you're so fearful that you want to store a value type asset. We also had gold go up while the dollar was up more than 5%. That has never happened either, right? Normally, gold needs a weak dollar. And then lastly, gold went up in 2024 in spite of rising rates. Since gold pays no dividend, higher interest rates are competition for money that would otherwise go to the gold market. So I think gold is looking to express a view. This is not a recommendation to buy gold. It's really more of what signal is coming from the gold market that inflation pressures are in fact building. We need an asset that can hold its value in that inflation, and that does reconcile with the message that we're getting from the bond market. So I do think having a plan for higher inflation in 2025 is going to be critical to success.
Yeah, it all really does boil back down to whether inflation is, higher levels of inflation is here to stay, or maybe reignite, or whether the Fed has actually got it under control and we're able to get our arms around it and bring it back down to close to target rates. A great discussion, Neil. I really hope everybody enjoyed that. It's always an exciting time in the investment world. There's always a lot to talk about, a lot to be looking forward to, but also cautious of as well. These are ultimately risky assets, so there's risk associated with investing, but over the long term, you can look at any performance chart of any broad market indices and you'll see just what a great value and wealth creator it is as an asset class. But there are periods of time when we need to be allocated correctly. So a lot to look at in the new year, and a lot to enjoy as we look back at 2024. Well, thanks for joining us here on Modern Wealth's Market Update Call. Neil, really appreciate you and coming on with your wise words. And we look forward to continue the conversation into the new year.
Thank you, Doug.
If you have any questions about what you heard today, please don't hesitate to reach out to us. If you like this video, please like, share, and subscribe.